All right. Hello, everybody. So this is our class for week 4. And in this class, I'm going to talk about large commercial organizations and the separation of ownership and control. Okay. So last week we talked about small business. Okay. We talked about small private companies, LLCs, which characterize many small music ensembles, art galleries, things like that. And you remember the point we made in the discussion sessions that we had was that sort of a factor in these businesses that may seem obvious, but it's actually a big deal, is that the owner of the firm is also the manager, and that this causes incentives to align really well, because the the manager of the firm has every incentive to be sort of as good as they can for customers that they're serving, because that's their income, it's their profit. If they run the business badly, okay, if they give poor performances, if the art gallery has very poor customer service, they're not going to earn very much money, and so there's all kinds of incentives to do that. In larger firms, things are going to change, because in larger firms, whether non-profit or for-profit, we're going to find that you start to get a separation between ownership and management. Okay? Because the people who are skilled at management do not have typically the financial resources to have a multi-million-dollar organization. They might be a very skilled manager. Many of you in this class might be really skilled managers, but you simply don't have that kind of capital to start up a huge business like that, right? So you need either a nonprofit form where there's a lot of investment from donors, people who want to found it, or from a large corporation where outside investors come in, okay? So that's what we're going to start to talk about this week. There's a term, and I should say that I've posted the notes that I'm using for this talk, I've posted them in the module, so you can actually read along if you want to. But there's an important term for us to know, and it's called the residual claimant. Okay, the residual claimant. So, and this is an important term for you to know. So what does that actually mean? Well, the residual claimant is, think about running a large business, okay? And the business earns a bunch of revenue from selling things, or if it's a nonprofit, from getting donations or grants from foundations or governments. So revenue comes in, and then a lot of expenses have to be paid out. You got to pay the salaries of your workers, you got to pay your rent, your utility bills, any other inputs you buy, everything like that. Okay? Now imagine at the end of the game, you've had all this revenue come in, you've paid out all these obligations, and there's money left over. That's profit. Who owns that? Who gets that profit? And that is who we call the residual claimant, okay? The residual claimant is essentially who gets to claim what's left over after all the revenues have come in and all the obligations in salaries and rent and utilities and so on have been paid out. Who gets that money left? That's the residual claimant, okay? In a small business, like we talked about last week, the owner-manager is the residual claimant. The owner-manager, whether it's a one person or a partnership, they take the revenues, they deal with all their expenses, and they split up, if it's a partnership, what's left over. They are the residual claimants. They get that. If there's a loss, they're responsible for that too. They've got to figure out a way to finance that. So that's what the residual claimant is. So, in a large corporation, who are the residual claimants? And the answer is the shareholders. Okay, so the stock market has been in the news quite a bit this past week with AMC and GameStop and so on. But when you buy stock, when you buy shares on the stock market, essentially you are buying a share of the company. Okay, you are becoming a part owner. That's what a share is, right? It's part ownership. And the shareholders are the residual claimants. Okay, so if the company earns a profit, shareholders earn what's called a dividend. They get a payment that comes out. It's also the case, that the firm might suffer losses, in which case there are no dividend payments, and in fact the share values might come down. But the shareholders are the residual claimants, and their returns depend on, well, what's left over after all the revenues have come in and all the expenses have been paid out. The residual claimant bears the risk. Okay, if you work for a company for a salary and they say, we're going to pay you $42,000 a year, unless the company's at risk of going absolutely bankrupt, you don't really face any risk, right? You know exactly what you're going to be paid every month. The shareholders don't know what they're going to receive because profits can never be perfectly forecast, right? They might be high one year, they might be low another year, dividends might be good one year, crummy the next year. They're bearing all the risk, okay? They're bearing all the risk. So in a large, complex organization, okay, the shareholders need to hire managers to run the firm. And so, as I say, you have this separation between ownership and control. If you bought shares in AMC Theaters last week, then you owned a share of the company, but you took no part in management. You weren't running the company. They have different managers, right? So you get the separation between ownership and control, okay? So that's the first thing to notice there. Big companies have a separation of ownership and control, and in a private corporation, the shareholders are the residual claimants. Okay, so here we got a problem. How are the shareholders going to make sure that the managers are doing a good job, right? I mean, because, you bought these shares because you want to earn money, you want to earn profits, you've made an investment. Who looks over the managers, right? Who's in charge of them? Well, this is where the board of directors comes in, okay? So when you first start to look at companies, both private corporations and nonprofits, a question that comes up is, well, what do boards do? What does a board of directors actually do? Well, this week we're focusing on the private sector, and it turns out that boards of directors in commercial companies do much the same thing as the board of directors in a nonprofit, which is they oversee management, okay? And they represent the interests of the residual claimant over management. So if you own shares in a company, the board of directors is essentially there to represent your interests as shareholders. They're representing you, and they're going to oversee management, okay? And they have the power to hire and fire management, okay? That's one of the big responsibilities that a board of director has. Okay, so who decides actually what decisions the company is going to make? Who's in charge of that? Is it management? Or is it this board of directors thing? And here we come, and you'll see this on page 2 of the notes I posted, sort of the basic sort of 4-stage structure that governs how these things work, okay? And I'm talking about commercial firms this week, but actually it applies to nonprofits too, same thing. So, step 1, management initiates proposals on what to do, okay? So management keeps the board informed. This is a big thing I want to do. Now we're talking about big things here, okay? For small matters like, hiring staff or, making small decisions, management does not go to the board. Management just does their job managing. But for big strategic things, okay, here is our 2-year strategy for moving into this new market. There, management has to go to the board and proposes, I think we should do this. I think we can make, real inroads in this new market, and we should try it. Okay, that's a strategy. So management proposes that. That's step 1. Management proposes ideas. Step 2, the board, okay, the board representing shareholders, looks over the proposal and evaluates it and ultimately either gives the green light, yes, we approve, go do that, or no, we actually, on consideration, don't think this is going to work. It's too risky. We've seen other companies really come to grief when they've tried to do this. We don't think it's a good idea. Okay, so the board kind of gives a green light or a red light, and often there's a bit of back and forth and discussion, but the board then ratifies the strategy. Okay, the board then ratifies the strategy. That's step 2. Step 3, okay, management now has to go do the job. So suppose management had proposed, I think we should make a real push into Latin American markets. The board has looked this over and thought, yes, we think that's actually a good idea, go do that. Then step 3 is management says, okay, and they start putting the stuff in place to start up exports into Latin America, maybe open up some branch plants there, sort of get the work going. Okay, step 3 is management actually does the thing they said they were going to do. Step 4, last step, is the board kind of monitors this. The board will ask for reports periodically on how is that Latin American strategy going. You indicated that, we would see these kinds of profits in the end. Show us the numbers. How did this actually turn out? The board oversees and evaluates, well, how did management actually do? Okay, so you got 4 stages. Management proposes an idea. The board ratifies it or sends it back. Management does the thing, right? Actually starts doing it. And the board evaluates, how'd that work out? Okay, how'd that work out? In the second half of this course, we're going to be talking about strategic planning. And especially within nonprofit and public organizations, setting up a strategic plan. I'm just going to give you a preview here, but they actually work the same way, right? They actually work the same way. Management proposes a plan. The board, with maybe a bit of back and forth, ultimately ratifies something. Management goes and does the plan, and then the board evaluates, okay, how did that work out? Okay, show us the numbers, show us the results that you actually, first of all, did what you said you were going to do, and secondly, how well did it go? Okay, so that's the basic 4-part. That's the basic 4-part structure. If management does a terrible job at it, the board is actually within their rights to fire the manager. Okay, if management does a great job, then the board is within their rights to reward the management team and say, good job, here's some bonuses, whatever. But that's how it works. The board does not do management, okay? It ratifies those strategy, but it is out of order for the board of directors to try to get into decisions below the sort of grand strategy level. It's not up to the board to ratify every single staff hire in the organization, every single purchase, every single marketing decision. It is within the board's purview to do the big stuff. You want to let managers manage. That's what they do. But managers have to have some oversight. Somebody's got to be making sure they're doing it right. Okay. So this is standard practice. Okay. So both in private sector corporations, commercial corporations, and in nonprofits, that's the basic setup we see. Okay, that's the basic setup we see. On page 2, I have some notes on, kind of a longish phrase there, institutional isomorphism. And this is the idea that, well, most all companies do this the same way. They all kind of look the same. It's not that there's a law saying they have to do this, but it just turns out that it works. Okay, this seems to work. Now, there are sort of 2 kinds of people in the world. One kind of person says, well, if this is what everybody's doing, it must be because it's efficient. It must be that it works. Inefficient methods would simply die out. Efficient methods stay on. And so this must be a good system. Pessimists, when they look at institutional isomorphism, the fact that all institutions come to look the same, pessimists are, well, maybe they're just kind of pressured into doing this. It's sort of a risk-averse strategy to follow the herd and do what everybody else is doing. People differ in this regard. Maybe we end up with very inefficient ways of doing it, but we get sort of stuck in a pattern of everybody doing the same thing. On this matter, I tend to think it's fairly efficient. I do tend to think that this is the best way to do it. Have the board oversee management, have the board check on grand strategy, but do not have the board micromanage. Okay? Some of you may have worked in nonprofit organizations where you get a board member who does want to micromanage and who does want to insert himself or herself into sort of daily routine decisions. And if you've ever experienced that, you've seen firsthand what a bad idea that is. Okay, so that is the basic structure. The board is representing the shareholders. Okay. Board members are often associated with other companies, though not direct market competitors, and they bring all different kinds of expertise. So the board in a corporation, you will get people who have expertise in strategy or finance or law. I've given the link in my notes to the board of directors for Cummins, which is a major machine manufacturer in Columbus, Indiana. If you've ever driven through Columbus, you know it's a huge manufacturing plant, very major corporation. And so you get a lot of, sort of direct expertise there. And so, you're sort of depending on that. And this is a good way to do things because shareholders otherwise don't have the time. Right? They don't have the time. I mean, I have money in my pension fund. At least some of it is in shares of stocks, right? Not all of it. As you get older and closer to retirement, most financial companies will start to put less of your pension funds in stocks because they're risky, and more of your pension funds just into government bonds and things like that. But still, I own shares in some stocks through my pension, but I don't have time to oversee what companies there are or how they're doing or what management is doing. I need a board to do that for me, okay? So they represent my interests in that. With my funds, I want my share prices to go up. So this is actually as good a place as any to have just a little digression for those of you not familiar with this. In the stock market, what causes values of shares to go up and down? At the end of the day, when you listen to the news on the radio or watch the news on television, they will often say, here's what the Dow did today, here's what the S&P index did today. What's actually going on with that? So just to explain it to you, if news arrives that things are looking particularly bright for some companies' profits, and I'm talking about their profits here. So if there's some news story that comes out that makes people think, wow, this company is actually going to do better than we previously thought, then lots of people out in the market will think, wow, if it's going to be really profitable, I would love to own shares in that company because the profits look really good. So lots of people put in orders to say, I would like to buy shares in that company because I think it's going to be quite profitable. Well, just law of supply and demand. If lots of people put in bids, I want to buy those shares, that pushes the share price up. So what causes the share price of any stock to go up? It is news. It is good news about that company. It has to be news. Old news is essentially already factored in. So it's something new that happened. If the economy as a whole gets news that things are looking good. So suppose we get a news story saying, wow, there's been a major drop in the number of new COVID cases and major improvements in the vaccine getting out there. Then everybody thinks, wow, the whole economy is going to start to do better than we thought because this is really good news. That tends to push every share price up. And then you get the whole sort of stock market going up. The numbers you see at the end of the day in the news with the Dow and the S&P, those are indices of a collection of shares where they sort of measure how did this bundle of shares go up or down over the course of a day. So that's what you're seeing with that index. But always keep in mind when you see those share prices that they are reflecting expectations about corporate profits. Okay? It's not saying anything about people's wages are going to go up. It's not saying anything about, we're on the track to reduce poverty or anything like that. It's about profits. Okay? So a mistake that people sometimes make in media that I get really mad at is they conflate what the stock market is doing with the economy. But the stock market is not the economy. It's a part of it. It's reflecting corporate profits, and that's all it's reflecting. Okay? So, good to remember that. boards use their power. I'm on page 4 of my notes now. We should note here that corporate boards will fire management. Okay, they will seek to replace management if management has been doing poorly. Is it the case that competitors in the same industry seem to be doing much, much better compared to your own management? They will actually use that. So a big task for boards is to replace senior management. Boards do not get involved in the hiring of all staff, but they do get involved in the hiring of senior management, okay? So the board of directors of IU does not go over the employment of every single staff member at IU. That would be crazy, right? It would be micromanaging and take too much time. But they will approve the hiring of a dean, say, or any management level above that. Okay? That's sort of the first half of what I wanted to talk about this week. The second half, and here I'm just going to keep it fairly short in this discussion, but I'm going to ask you to do the reading so that we can actually discuss it in our sessions, is about what should commercial firms maximize. Okay? Now, the way I've been describing it so far is that the board is going to make sure that management is doing a good job pursuing profits, because that's what shareholders want them to do. All right? But there's been pressure, it's always been around, but I think especially lately, that private corporations should do more things for the social good. Okay? That they should adopt, either environment and sustainability policies or wage policies for their workers in ways that might not increase profits and in fact might be costly, but would be for the social good. Okay? So, pressures that a company should adopt sustainability measures beyond what the law requires, even though it would be costly, even though in the end every calculation says, this is actually going to cost us, it's not going to make us money, that they should do that anyway because they have a social responsibility to do so. That even where economically they don't have to increase wages of their employees, that it would be a loss-making thing to do so, they should do it anyway for the social good and just for ethical reasons. And so it's a question that comes up, well, should companies do that? Should shareholders do that? And I have you read some Milton Friedman. Milton Friedman, interesting economist. He is sort of the name most associated with what is called the Chicago School of Economics, which is a very sort of free market ideology. Okay? And you'll find in the readings, we read some Friedman, where Friedman essentially says, absolutely not. Corporations should not do this. The job of corporate boards is to make sure that management pursues profit and maximizes profit. And his reasoning is that, well, if you're a shareholder, that's what you've bought shares in the company to do. And if they are pursuing sort of social goals because members of the board think, oh, we should be more socially responsible, how do we know that's what shareholders actually want? As a shareholder, I can say, yes, I get it that the board is trying to get this company to maximize profit, but I haven't actually directed them to pursue social goals. What if they're pursuing social goals that are different from my goals? Maybe I have different ideas about what should be emphasized. Friedman says, companies should operate within the law. If we do have social goals, we should pursue legislative solutions to that. In other words, if we think, as a rule, the minimum wage for workers should be higher, then we should elect politicians who would pursue a higher minimum wage, do it that way. But don't just have shareholders say, well, we should increase the wages we pay because it would be fair or it would be nice. Friedman says, no, they should be pursuing a wage policy that is profit maximizing. Okay? this is a really interesting question. This is a question that's not going to go away, but you do have this big overhanging question of what corporations should be seeking to emphasize. When you read Friedman, he says, look at Adam Smith, right? And we read Adam Smith in this class. Adam Smith says it is great that companies pursue profits because that gets us a really good outcome, right? Remember that line about the butcher, the brewer, and the baker, right? Companies pursuing profits actually give us good results. Friedman says we should stick with that, but there are criticisms saying corporations have more social responsibility for that. But I'm not just going to lecture you on that. I think that's one that we should discuss in class. So I will leave it there. Thanks very much.